Good afternoon, everyone. We are the Group 7 and we will be discussing Module number 4, Managing Checking and Savings Account. So, our table of content would be our team's introduction, discussing monetary asset management, tools, electronic money management, and the psychology of money management. So, our team introduction would be, first is me, Angelo Celedonio, Mr. Harold Cabias, Miss Nicole Rivera, and lastly, Miss Luella Rollo. To start with monetary asset management, what exactly is a monetary asset management? So, it is how you handle all of your monetary assets. Cash on hand, checking accounts, saving accounts, and certificates of deposits and money market accounts. So basically, it is how you handle your daily expenses separated from your emergency expenses, and for the excess money to be on investment opportunities. You will use the excess funds to grow that small leftover of your money. That's basically the purpose of monetary asset management. It is to maximize your interest earnings while minimizing your spending costs. That's why if you use monetary asset management correctly, you will be safe from financial risk. Next is the 3 tools of monetary asset management. The first is the low cost interest earning checking accounts. So what is a checking account? So checking account is an account that you will use for your short-term spendings, like your daily expenses. You use your checking accounts for that. And bills, electric bills, water bills, things like that. What you spend on a daily basis can be taken out from the checking account. Next is interest earning savings accounts. So savings accounts are in money that you deposit. You save from an account, bank or credit unions, those kinds of institutions, and you deposit your money to save it, and while earning interest in that account. The next is money market accounts. So in money market accounts, it's similar to savings accounts. However, money market accounts provide you more interest earning than savings accounts. Next is who provides these monetary asset management services. The financial services industry comprises companies that provide monetary asset management and other services. So the ones who provides these services are firms that depository institutions, those kinds of firms. So inside the depository institutions are institutions such as banks or credit unions, one where you deposit your money and they provide security for your deposited money, which you can take out anytime you want. So next is, yes, depository institutions. Like I said earlier, depository institutions are organizations that are licensed. They can offer government account insurance on their customers' deposits. Basically, institutions that banks, saving banks, credit unions, things like that. Institutions that provide security on the money that you deposit. Those are depository institutions. Next is other financial services providers. So the other financial services providers, first is mutual funds. So mutual funds are investment companies that raise money by selling shares to the public and then invest that money in a diversified portfolio of investments. So mutual funds are those companies who assist you in investing. They gather other investors money to deposit them, to invest them in various investment opportunities such as stocks, bonds, things like that. Next is stock brokerage. So stock brokerage firms are licensed financial institutions that specialize in selling and buying stocks. Similar to mutual funds, they sell and buy stocks on your behalf. They provide assistance and advice to you, their customers. However, it is for individuals. So they stock brokerage firms buy and sell investments for you, and the excess money on your account that were not invested will be secured in your account, which you can take anytime you want. Lastly are insurance companies. So insurance companies are basically companies that provide help to you in case you are in an accident. Like, take for example, vehicle crash. You crashed your vehicle. However, the crash accident was not your fault. It wasn't caused by you. The insurance companies will take care of the expenses needed to remedy that crash. However, they only take care of the expenses when it truly is an accident. If you were the one who caused the accident, the insurance companies will not be able to help you because it is a man-made accident. So anyways, that's all for me, and the next reporter will be Mr. Harold Cabias.
A checking account allows you to write checks against your deposited funds and send money to others. It is accessible by debit card, ATM, POS terminal, phone, or computer. Transactions should be recorded in a check register with sums deducted and deposits added. Various accounts types and associated charges are explored in greater detail. A saving account functions as an easy, accessible emergency reserve as well as temporary storage location for surplus funds. Interest rates are usually slightly higher than those on checking accounts. Saving accounts are term time deposits, and some results early notification of withdrawal. Fixed time deposits such as certificates of deposit or CTs have specific holding periods. When income exceeds costs, it makes sense to transfer surplus funds to higher interest accounts. A money market account combines checking and saving features and pays attractive interest rates with limited check writing rights. Super and OW accounts, money market deposit accounts, money market mutual funds, and asset management accounts are among the options provided by numerous financial institutions. A money market mutual fund is an investment account provided by mutual fund firms that pools cash from multiple clients to purchase short-term debt. It provides a secure and profitable return, often offering the highest rates accessible to small investors. Interest is compounded daily, and cash may be withdrawn at any time. An asset management account, or AMA, often known as an all-in-one account, combines multiple monetary assets into a single package that is reported on a monthly basis. It can contain transactions from money market, mutual funds, checking, credit cards, loan, or brokerage account. AMAs simplify financial management, which is provided by depository institutions, brokerage firms, and financial services organizations, allowing all financial activities to be handled by a single institution.
Good day, everyone. My name is Nicole Rivera. Today, we will talk about the electronic money management. What is electronic money management? Electronic money is a digital currency maintained in a bank computer systems. It can be used to make electronic payments and is usually backed by regular fiat currency, so it can be changed into cash if necessary. The primary benefit of electronic money is the simplicity and convenience it provides for online transactions. Now, how electronic money works. Digital currency, also known as electronic money, is a universally accepted currency utilized in online banking systems, and regulated through electronic processing. While it can be converted into fiat currency, digital currency is primarily held in secure bank vaults and supported by central banks. Under special considerations, first we have currency in circulation. Electronic money is often kept in banks for use in online transactions. Prepaid cards are free-loaded with money, whereas digital wallets such as PayPal and Square allow users to deposit real money and conduct electronic payments while earning a modest fee. The second one is the electronic payment processing. Electronic money has become the backbone of American transactions, replacing cash for direct deposits, online transfers, and card payments. This digital form of currency, stored in banks and accessed electronically, offers security and convenience. Major payment processors like Visa and MasterCard ensure smooth electronic money transactions, making them a secure and efficient alternative to physical cash. Next is the use of plastic in monetary asset management. There are many types of plastic devices used to access your money, so I will tell you one by one. First we have is the ATM. ATM cards allow you to withdraw money and transfer funds between your checking and savings accounts at an automatic teller machine. To access the card, a personal identification number or PIN is required. Next is the debit card. Debit cards are better than ATM cards because they can be used for purchases at retail stores. Using a debit card immediately transfers money from your account, and it requires a PIN or signature. Next is the stored value cards, which function like mini checking accounts with a magnetic strip or barcode encrypting the stored money amount. They are accepted wherever the card is, such as gift cards and refund or rebate cards. Some of these can be reloaded, like Walmart's Visa debit card. The next one is the EBT cards that are used by the government to pay military personnel and provide social security and other government benefits. They function like a stored value card, but the holder does not need to load them. The last one is the credit cards that allow you to buy things using credit from the bank or the shop that gave you the card. You have to pay back this credit, often with extra money called interest. That's all for my report. The next reporter will be Miss Rolio Liuela.
Good day everyone, I'm Leila Merolio and I'm going to discuss the psychology of money management. Conflict over money are common in relationship due to challenges in managing finances together, such as budgeting and debt management. Recognizing this is critical for building trust and attaining financial success in partnership. In everyday life, this knowledge helps couples negotiate financial problems and create mutual trust, resulting in a harmonious and productive partnership. Managing money and making financial decisions are different. Managing money involves handling everyday financial tasks like budgeting and shopping, while making financial decisions involve planning for future. Understanding this difference helps couples work together effectively, reducing stress and promoting harmony in the relationship by ensuring that responsibilities are clearly defined and shared. People ascribe strong emotion to money. Money affects our emotion deeply, influenced by how we raise and what we believe. Understanding and talking openly about this feeling is important for building strong relationship and feeling confident in managing our finances. Understanding and mastering financial management is a crucial milestone in adulthood, emphasizing the need for excellent money communication to effectively navigate life financial issues. How to talk about financial matters. Conversation regarding money can be difficult because people might be unpredictable or reckless about financial problems, while being rational in other areas. Recognizing and appreciating genuine differences in financial belief is critical for encouraging open discussion about money and establishing trust in relationship, particularly when making joint financial decisions or managing shared spending. Here's the following idea will help you discuss money with more confidence and candor. First is get to know yourself. Before discussing money matters with others, it's crucial to understand your own financial approach by reflecting on money-related emotion and personal financial behavior. This self-awareness can provide insight into how upbringing and past experience shape view about money, which can then inform discussion with partners or family members about shared financial goals and responsibilities. Focus on commonalities. Financial discussion entails identifying shared goals and reaching consensus without disregarding individuals' perspective. This approach fosters collaboration and understanding, particularly when making decisions about shared expenses or investment, ensuring that both partners feel valued and respected in financial matters. Learn to manage financial disagreement. Managing financial disagreement requires creating an environment of open communication and constructive conflict resolution, allowing each family member to express their concern and preferences. By actively listening and compromising, families can reach solutions that satisfy everyone involved, ensuring productive and respectful financial negotiation. Using positive I. Using I statement in financial communication allow individuals to communicate their views and worries without blaming or criticizing their partners, promoting understanding and collaboration in addressing financial challenges within relationship. This technique encourages healthy discussion about money management, minimizing disagreement and increasing trust, particularly when dealing with sensitive topics like spending habit or budgeting decision. Lastly, be honest and talk regularly. Being truthful and communicating about finances on a regular basis is critical for reaching agreements and ensuring financial harmony within families because it is foster trust, allow for compromise, and facilitate effective short-term and long-term financial planning, all which are necessary for managing household expenses and meeting financial goals. And that's all for our report. Again, we are Group 7 discussing Module 4.